Just to my immediate left is Rudi, Don and Rob down the end. So I'd just like to start with a poll question. So if you could whip out your phones, please. I've just got a couple of poll questions that I'd like to get your thoughts on. The first one is where you like to generate most of your income from. The options are high-yielding equities, cash and government bonds, credit including hybrids, rental income from perhaps your direct property portfolios or annuities. And the second question, if you could please tap it in, is what's a realistic yield that you think you can generate from your portfolio without taking on excessive risks? The answers options there are vary from 2 to more than 5%. So as you enter those answers in, if we could just have the first poll result, I'd just be interested to get a sense of what the audience is reacting there. So perhaps no surprise, you guys love equities, as been discussed at length. And if we could have a look at the next poll result, please. So yeah, there's some, most people are kind of hoping sort of they were 4 to 5%, or perhaps even a bit more than 5%. So I guess maybe just on that kind of starting point, maybe just be interested in each of the panelists' thoughts on maybe that's the results to the second question. People are still hoping for sort of the five potentially more than that in income levels. Rudi, perhaps what do you kind of think of when you see that sort of answer?
Yeah, I think it's clear that in this kind of a low rate environment, equities are being called upon to do a lot of the heavy lifting in most people's portfolios. So that allocation to shares to generate income is an answer that I would expect to see. When we come to what kind of number you can expect, I think my take here is that definition of how do you define excessive risk. I always like to think about risk being defined as more things can happen than actually will happen. So in that context, thinking about risk makes me question how much you can get more than 5% before you are really in an at-risk component of your investment portfolio. And that balance between income and risk certainly needs to be considered.
Cool. Return to that topic. I mean, Don, you're probably pretty happy to see that most people are favouring equities, given what you invest in. I mean, do you think some of these responses are appropriate?
Clearly in a low interest rate environment, particularly Australian equities is going to give you those sorts of numbers. I'm not surprised about the 5% number, because that's the drawdown for most people in retirement. Sometimes it's more. But clearly, in the environment we are, the RBA is pushing people into risky investments like shares to generate high levels of income. So I'm not surprised, although the 86% number was pretty high.
Rob, you're a specialist in bonds. You're kind of not getting much love from the crowd. And how do you react to that?
I guess there's only upside for me from that allocation, so it's fantastic news. But no, seriously, and this is going to be a big debate over the next half an hour, is equities can't solve every problem for you, especially at the level that they're priced at now. So I think one of the most important takeaways from today is that the only reason asset prices are where they are is because of where the level of interest rates is to begin with. So to be willing to run such an aggressive position and have zero defense in the portfolio, given that we're already at these levels and given that interest rates really can't go much lower, it's sort of the good news, bad news. Great news for bond managers because there's flows definitely coming as soon as the market cracks. But bad news is we're probably, as an investor base, running way too much risk.
Great. Just on that point, perhaps, Don, what do you kind of think about the potential for, the perception that running too much equities is potentially too risky, and whether you're perhaps relying too much on them for this level of yield?
Yeah, well, I would never advocate people put 100% of their money in equities, even though I'm an equity manager. You do need a diversified portfolio. The first free lunch is diversification, and that's putting it into different asset classes, whether it be some bonds, some cash, some infrastructure as talked before. But clearly, with interest rates, I would actually argue the expensive asset at the moment is not shares. The expensive asset is cash and bonds. Because, I know we don't talk about it, but what is the PE of the cash rate at the moment in Australia? It's more than 100. The PE of a 10-year government bond in Australia is more than 100. You have to put $100 down to get less than $1 worth of interest. So the expensive asset, and it's caused by quantitative easing, it's caused by central banks, pushing rates to ridiculous levels, is actually cash and bonds, because the RBA and other central banks want you to put money in risky assets. I don't think equities actually factoring in 1% interest rates. I think they'd be much higher if they thought interest rates were staying at 1% forever.
Either you guys want to respond? Either Rob or Rudi? Rudi, you kind of look across the capital structure, both equities and fixed interest. I mean, what do you think of Don's sentiments there?
Oh, look, that notion of diversification is absolutely critical. It's not only across the asset class, but also within the asset class itself, you've got to be really careful. And part of the challenge when your mindset shifts to income generation from equities is, do I even further exacerbate some of these risk concerns? If I end up with very similar stocks in very similar sectors, we use this term, this singular risk, and it actually comes back to equities that are income generated can often be very much connected to the interest rate sensitivity. So if all your stocks, they may be very different in their sectors, but ultimately if they're all just focused on the income, you run the risk that your portfolio doesn't have enough diversification within the equities component, let alone across the broader asset class. And so the real challenge with thinking about your equities component when you want to generate more income is, how do I balance that need for the income side without compromising on the risk side of the equation?
I'd agree entirely with that. I don't know if my chart made it, but it highlights probably exactly that story, if you can put that chart up there.
Sure.
This following chart highlights, I think, the concentration and some of the risks Rudi's talking about in the Australian equity market. So the pie chart is the amount of total dividend income, including franking credits, in the ASX 200. So basically the Australian market. And six stocks, and 4 of them are banks, represent almost half, just under half, but I can tell you 2 years ago it was over half, of all the income in the ASX 200. And 4 of them are in the banks that are all affected by the Royal Commission and all those sorts of things. So incredibly concentrated. So having all your money, and then the risk is shown on the second side of that chart, where we actually have in light blue the performance, just the price performance of the ASX 200 index over the last couple of years, and the performance of, in black, the big 4 banks, and in blue, one of the other 5, or the 5th high income stock is Telstra, which I think a lot of people have thought is their income stock. They've significantly underperformed the market. In fact, Telstra today is about 40% lower than it was 4 years ago. And if you're an investor in Telstra, you probably realise you're now getting half of the dividends of what you got 2 years ago. So you've lost half your income and you lost 40% of your capital over the last 4 years. That highlights the concentration risk, and banks haven't been much better, although they haven't up until now, apart from NAB, cut their dividends, but they're potentially come a dividend cut. So yeah, you need a diversified portfolio both at the sector level, but also, 2 stocks, 2 banks in Telstra or 4 banks in Telstra is not a diversified portfolio.
So based on that, your opinion is global exposure? Is that your main answer, Don?
My answer is, if you're in Australia, you want to have more than just 4 banks in Telstra. You need to have a diversified portfolio. We've got resource stocks. BHP's the odd man out there and has been paying fantastic dividends. But I have a second slide which never quite made it. But yeah, if you look globally, you see much better diversification, much less concentration. The top 6 stocks, only one of them is a bank that are dividend payers, and you actually get some exposure to IT in the top 6 dividend payers globally. So yeah, you should have some of your money in global shares, even though the yields are much lower. That diversification and getting away from having all your money in Australian dollars. The Australian dollar's been going down for the last 5 years, something like that. If you've got overseas assets, they go up when the Australian dollar goes down.
Okay.
Yeah, I think we're all saying, I guess, very similar things. And the words on the chart, diversification, once again. And I think the most important thing is to think about, when we went into the financial crisis, as an economy, we had a cash rate of 7.25%. Now it's 75 basis points, 0.75%, and it's going lower. So you need to think about how to adjust your earnings expectations, your income expectations in that environment, because if if everything was okay and the economy was going to be growing strongly, earnings were going to be growing strongly, investment was going to be growing strongly, the cash rate would not be where it is now. So it's telling you something very, very important. The RBA is saying this economy needs help. It needs more help than it's ever needed. And we're not getting that help from our government. The fiscal spending's not coming. They're actually probably going in the opposite direction, at least temporarily. So expect these low interest rates for much longer. So what that means is you need to change your mindset around asset allocation. It's no longer okay to have term deposits and Aussie equities. There's a whole gap in the middle that some of the other, Don and Rudi have mentioned, that exist in the middle that can provide very, very, like much higher levels of income and much higher levels of diversification. And that's where we should be migrating to, not selling term deposits and buying even more Aussie equities, but filling that very, very important gap in the middle. Things like global credit, things like some of the listed investment trusts. There's lots of things in the middle that can still generate tremendous wealth with much less volatility than just chasing expensive equities.
Do listed hybrids belong in the middle?
So some listed hybrids, I'm not so, you shouldn't have, again, if you own Aussie property as part of your income, you own Aussie bank shares and you own Aussie hybrids all together, it's a correlated risk. So just be wary of that. But owning across capital structures, as long as they're priced effectively, still makes sense. So just be careful of that concentration, but having some diversification across like real property, bank stocks and hybrids makes sense, but don't think you're going to have that as your only portfolio allocation because they're very, very correlated.
I would question whether we're in the worst position ever and we need the most help ever, actually. I would say that I think the markets, and there's a lot of commentary about how negative it is and interest rates are all-time low and it must be bad and all that sort of stuff. I think you've got to take it into account that the rest of the world, Europe in particular and Japan, have negative interest rates. So ours are still relatively positive. So our central bank's saying, oh, they're very low, we're going low, but we're still not in negative territory. And to me, this is nothing like the last recession we had, which is nearly 30 years ago. I did go through that recession. And to me, it feels nothing like the GFC. So I don't think it's as bad in any way, anywhere near the past, but yes, it's definitely a soft economy. Things are slow, but we've got, 5.2% unemployment today, which is actually pretty low. Growth only 1.7%, but it's actually positive, not negative. So it's slow, but it's not, let's cut our risks type situation.
Just to your question on hybrids, Tim, I've been allocating to hybrids selectively for over 15 years, and the thing that stands out is what I called a hybrid security those 14, 15 years ago is completely different to the securities I'm looking at today. The terms and structures that are embedded in those 80, 90-page documents that arguably do we all read have so much information that is very different and needs to be understood on a security by securities basis. It's really important to understand that these securities are the tail risk shock absorbers. They're there if a stress event happens for one of these companies, that is not a deposit investment, that is a capital investment that will be used to prop up the security of the company. The other aspect that really needs to be understood is that when we think about issuances, and there's a new issuance out right at the moment that we're all familiar with by the Commonwealth Bank, so it's a strong company with a strong issuance history. The thing what you're actually taking into account is, when I think about that headline rate, and the CBA issue's got a 3% headline rate for 7.5 years, that term is actually got a double-edged sword to it. So yes, from an income perspective, it's potentially attractive that I get to lock in 3.5% above the risk-free rate for 7.5 years. But as Robert could articulate for hours on end, the double-edged sword of that means that if you do have changes in credit spread valuations, being such a long-dated security, you are going to be more susceptible to movements in the pricing of those securities compared to a shorter-dated security. So always think about that trade-off. Whilst I'm happy to lock this in for a long term, know that long term means you're more vulnerable to movements in the underlying valuation of the security as the market goes up and down. And so it really comes down to what else you got in your portfolio and what role that's going to play in your portfolio and whether you should invest in it or look for a more shorter dated exposure.
Great. So I've just noticed a couple of questions coming in through the app. Please continue to submit, and I know there's a couple of remarks around. Before we get to that, I've just got a few other questions that have been alluded to. So Rob, you kind of mentioned, in the context of stretching for yield, trying to achieve these sort of income objectives, perhaps we might need to think a bit differently. I guess in terms of, we've obviously seen low interest rates have coincided with significant increases in asset prices. I'm sure there's plenty of people here are wealthier than what they were in 2009. Do we need to perhaps rethink the reliance on just trying to draw income from your existing capital base and maybe potentially draw down on your capital given the wealth effect that's occurred, and how can you perhaps challenge that notion?
Yeah, I think it's sort of building on the previous session. It's unfortunate that our industry has matured at exactly the wrong time. So that as we move more people from accumulation to retirement in the lowest yielding environment, the most difficulty in generating a real return, so a return above inflation through retirement. So it's very unfortunate. None of this could have been planned, but it's the reality that we're all living with. I think the thing to think about there is to acknowledge that may be a necessity. So as Tim mentioned, to eat into some capital over time, especially where assets have performed very strongly. So it may make sense to sell some of those assets that have done well in order to subsidise income. I don't think we're at the extreme yet that has to be a sort of an ongoing reality. I do think that there will be some normalisation of interest rates over the next 5 to 10 years, but not much over the next 2 to 3 years. So you may have to bridge some of that gap. But one of the things to think about is, again, when we went into the financial crisis with the cash rate at 7.25%, to take no risk whatsoever, you generated sort of almost 5% real return. And since the financial crisis, the RBA's mandate has not changed. They're still trying to target inflation between 2 and 3. Yet 7.25%, 5%-ish real, now 50 basis points coming, negative 2% real. So it's a very, very different backdrop in terms of how to achieve a real return. So you need to adjust your mindsets around, even our own future fund is adjusting their mindset around reducing their expectation around what sort of real return they can generate. One of the most sophisticated investors, not only in Australia, but globally, acknowledging that some of that return expectation needs to be trimmed. So yes, temporarily, maybe that's one of the ways to think about bolstering some short-term income generation.
Do you guys have any other comments or thoughts on the issue?
I had an interesting anecdote. I was in Melbourne on Tuesday, and a client of mine, which is a financial planner, said I went to a client and they had $10 million in property assets. So they're very, very wealthy. Nothing in super, but their home is worth $7 million. They got $3 million in 3 rental properties. They cannot live on the rent from their 3 rental properties. So that's exactly, their asset rich, but their income poor, and that's the problem with the current world. And so I think some people do have to think about, well, I do have to sell potentially some of those assets, and particularly if it's in very low yielding, because CBD or central property is pretty low yielding, you probably do have to sell some, maybe consume some of that capital, but potentially reallocate to high yielding asset classes.
From my take, I think this drawdown of capital is a really challenging discussion. I mean, just the other day I was reading that there's policy debate on whether we're going to define what we need to think about from our management of our assets in superannuation and other investments, from not just life expectancy, but potential life, which sounds pedantic, but it's a change in rhetoric to how long we need to think about how long we need our capital to last in our investment portfolio. So to talk about drawing down capital at this point seems at odds with where policy might push us. But that discussion on should I draw down capital, what I do like about that discussion is we're talking about long-term thinking. And part of the challenge I observe from an equity income perspective is that when we talk about income, we talk about it as a near term, which makes sense to a degree because there's the immediacy of the income need. But when we're thinking about an asset class like equities, which is a long-term investment, and your need for income is not only an immediate issue, but also a long-term issue, we need to think about income through that lens of long-term thinking as well. I don't know if it's a good time to bring up.
Sure.
Let me bring up my chart here. One of the things I've found fascinating is that this interchangeable use of the words yield and income. And when it comes to investing in equities, they actually don't mean the same thing. And what I've got here is, as a simple exercise given the time, is just how a simple investment of $10,000 in a range of 4 different stocks has gone in the delivery of income. So I picked out, unashamed cherry picked here, 2 stocks that we all as a group of investors love to call income stocks, and 2 stocks that we would put into a growth stock bucket. And what you can see here is on the left-hand side that if you're investing in equities for income, can you understand how it is that stocks which had materially lower yields have delivered significantly more income in dollar terms? The language that's most important to you is dollar income over the long term. And that's on the left-hand side is a cherry-picked example, and on the right is just from this exercise where we looked at all stocks that had a 15-year history. These are the stocks which are your quintessential high yield basket of stocks. Don's already called out the most famous 4 stocks. But just observe, whilst these stocks rank very highly on yield, they don't necessarily rank highly in income, which is that second column there. And the lesson for investors is that you should be investing in equities with a long-term focus for income. And part of the challenge is, how do I address that when I need my income today? And that's part of the role, which is a topic for another day from my perspective, of how you get that balance right in your portfolio. So this discussion of drawing down capital and thinking about income is actually more interrelated than most people like to think.
Sure. Perhaps the audience would be interested in hearing, Don, your thoughts on, from your perspective, any particular sectors or stocks that you think are particularly prime opportunities for generating income?
Well, this is short term, not the long term, but the short term, we really like iron ore miners. We like BHP, Rio and Fortescue. They've, despite the fact that iron ore prices dropped about 25% in August, they're still at $90 a tonne. They could take it out of the ground for 10 or 15 US dollars a tonne. It's a pretty good margin when you're pulling up 100, 50, 200, 300 million tonnes. Fortescue has paid out in the last 12 months about 20% of its capital value. And often when I say a stock is paid out, is trailing, is on a yield of 20%, it's usually because I don't like it. It's usually because the dividend trap and the share price has halved or gone down 80%, and that's why it's trading at a 20% yield. But actually Fortescue's gone up and trading. Now, albeit that's special dividends, so they probably won't pay them next year, but it's still on a pretty good yield. So we like those at the moment, but that is very much a short-term view. We're a very active manager. In 12 months' time, bets could be off iron ore if, depending on what happens in China and the US. But right now, and for the last 12 months, but we would think for the next at least 6 months, there'll be some very good dividends and franking credits coming out of that sector.
Okay. Let me just turn to some of the questions from the audience. I've got a couple of hands up. I think I saw someone earlier had a microphone. Yep. The gentleman just hand up. You want to ask a question?
Sorry. On account of the fact that there's a low yield, wouldn't it be appropriate for the government to, again, half the minimum drawdown, as they did a few years ago? The minimum...
The 5%?
Yeah.
Who wants to take that one on?
Well, it might be all right if you can live off 2.5%, but depends how much your balance is. But I think, that's set as a longer term notion, and they probably are saying that you can spend some of your increased capital values if you've got enough in super. But yeah, for some people, maybe you should actually consider whether they can adjust it. But I think for most people, if they've got sufficient balances, they probably should be drawing down 5%.
Okay. Just before that, sorry. Yep.
I think my question is probably to Rob, and it may be a little bit specific, but of interest to a lot of people. Just looking at bond ETFs and the sustainability of the yield that are coming out of them, how can we get at the underlying maturities of those bonds so we can get an idea of how long the honey's going to flow for?
Yeah, I think again, as a bond manager, I'm not going to suggest that looking in the rear vision mirror is a good indicator of forward-looking returns. So bonds have been benefiting from interest rates coming down for a very long time. Fortunately, it's something that we've thought was going to happen, so our investors have benefited along the way, but most of that capital gain, and in terms of the inverse relationship between a yield and a bond price, so as yields come down, bond prices go up, most of that is behind us. So factor that into your expected returns. The one thing in the bond market that still is available for investors to take advantage of is illiquidity premium. And that's the area where we're most focused with our institutional investors, and now obviously trying to make these opportunities available more broadly. And that's really to take advantage of that. So if you think about investing, in order to earn any return above the risk-free rate, you need to take some risk. So we all know, and we saw in the survey, that everyone in this room knows how to take equity risk. That's way overweight. We know how to take some, historically we've known how to take some term risk or property risk. So buying longer dated assets that are going to generate capital over a very long term. One thing that's way under allocated is illiquidity risk. And that's something that we think's the next thing for this type of investor base to focus on. That's looking at private credit markets, it's looking at listed investment trusts, it's looking at those sorts of things that can legitimately earn 4 or 5% above the cash rate, and in some cases give you daily liquidity, but the underlying assets are essentially illiquid. So that's the sort of area that we'd focus on most going forward. The other one area I'll mention briefly, for investors that have got very heavy allocations to risky assets, we still do think that the US Treasury market, so buying US government debt, is still defensive. Most bond markets around the world don't have many defensive qualities anymore. As Don said, a lot of them are negative yielding. There's a limit to how much defence they provide in a portfolio. But we do think US Treasuries still provide that defence and sort of have a larger allocation in most investors' portfolios than they do now. So sort of thinking about defence in that area and generating some uncorrelated income by giving up some liquidity.
Cool. Yep, just got a question out there.
There is, is that on? Yep. There's at least one industry super fund that's allowing self-managed super funds to invest in their various funds without becoming a member of that super fund. Is that a good idea?
Anyone want to venture a response? Anyone?
Can I add to that? I think I'm imagining the funding question is Host Plus, and the assets that are of particular interest, which the panel might like to comment on, is the unlisted infrastructure and the unlisted property trust. So what does the panel think would be the risks if the other questioner is happy of investing in the unlisted infrastructure that is not necessarily at a bubble, depending upon the valuation policies?
Yeah, I think if we're just talking about how to access assets that are typically difficult to access, then I think it's more about a funnel rather than making a decision on the underlying assets themselves. So I don't really know what's in those portfolios, but I would continue that theme I was raising before, that this investor base has historically found it difficult to access some of these less liquid assets, but the listed investment trusts of evolution, some of those are providing excellent ways to access them where that wasn't available previously. Some of the listed investment trusts aren't looking at illiquid assets at all. They're buying some of the most liquid stocks in the whole world. So there's different variations, but it is one way And similarly to the funnel you're suggesting as well, one way to access assets that weren't previously available, and that's really to acknowledge the fact that generating real returns is much harder than it's ever been in the past, needing to take more risk to generate the same level of return. So I think that will continue, and it's an area that we think is prime for this sort of SMSF investor base.
Okay.
I would just add that you need to just be aware of the risk. There are risks in unlisted assets, as the unlisted property trusts of the early 90s showed that those things can get into real strife and you just can't get your money out. So that's why they're illiquid. And you need to understand fully what you're getting yourself into, how they're valued, all those sorts of things, because they often look less risky than what they actually are.
Great. Okay, we're running a bit of time, but just time for one last question. Sorry? Sorry.
Thank you. Hi. I'll be loud. Paulina Duran from Reuters. My question is about the many now funds that there are now even listed selling access to high yields through credit and loans or bonds, and not only in Australia but also in Europe and in the US. I would love to hear your thoughts about that from you, from the three of you actually.
All right, maybe Rob, you might want to try and answer that.
Yeah, it's remember I said at the start there's historically been this big gap between term deposits and listed equities, and there's the gap in the middle. This is where this sort of asset class lives. It's not as though this has somehow been missing in action and no investors have been harvesting some of the value there. I'm not saying that these are the cheapest things. Every asset across the globe is at the higher end of its valuations, including that sector. But we still think it provides a very effective diversifier while continuing to provide a high expectation in terms of income. So it ticks a lot of boxes. Like every investment that's based upon underlying cash flows from companies, from other securities, choosing the right manager that can understand the sustainability of those cash flows is absolutely key. These are not riskless assets. They have plenty of risk. And so doing that bottom-up analysis, having faith in track records, looking for investors that have been involved in these markets for a long time is very important. So they're not all going to perform like an equity. They're not all going to perform the same. So just be very, very careful in terms of your due diligence when you look into that marketplace.
Great. Well, apologies if anyone's got any outstanding questions, but we're a bit over time, so we'll look to wrap things up. If you could please join me in thanking the three panelists today.
Any advice in this video is general advice prepared by Morningstar without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest.